Joining me now is DoubleLine Capital's Jeffrey Gundlach. He's with us exclusively, as he always is once the Fed chair finishes. Jeffrey, welcome back for our final visit of the year. I'm glad you're with us today.
Yeah, we made it all the way to December, Judge. Interesting times.
Yeah, that's for certain. I mentioned what Pisani and Leeman have called it. What would you call today?
Well, it's pretty dovish. I mean, the word of the day is any. Last meeting, the word was careful. He said that multiple times last meeting. Market likes that because it respected the fact that the curve's inverted and economy's slowing down. But that any word didn't have to be inserted. And it strongly suggests that the Fed inserted that because they believe, I think, that they're done. And not only are they done, what a lot of people don't realize is the Fed has been on hold for 4 of the last 5 meetings. So it's a trend. And we talked last meeting, November 1st, that we had started a bond rally that day. And what a rally it's turned into. It's turned into quite a good 6 weeks with the 10-year Treasury yield down 100 basis points and the long bond, up in the double digits. So we had a November to remember, one of my clients said in a meeting I did with him yesterday, with one of the best months ever for the investment-grade bond market, up over 4.5% in the month of November alone. That hasn't happened since the 80s, which is really something because last time it happened, you were starting with yields up at 10%-ish, and here you were starting with yields at 5-ish, so half the yield. So you needed an even bigger basis point move in rates. So I thought the most interesting thing in the press conference came near the end, where if I heard it right, I think Jay Powell said that he wants to cut rates before we get to 2, if I heard him right. And because he's respecting the momentum that inflation can have. Just like I criticized him 2 years ago for going too slowly, and inflation overshot by 500 basis points above where they thought it was going to 4% or so. It peaked out on the CPI at 9, and now it's coming down just as fast. And I heard a lot of people before the announcement were talking about, you can take 3-month PCE, you can look at core this and that, 1-month data and everything. There's ways to get to 2% sort of numbers. And I'll just add one that I didn't hear today. That's core CPI ex shelter, which is at 2%. And the reason I bring that up is shelter is a bad construct. It's owner's equivalent rent, and it lags. And it appears to our research that owner's equivalent rent is going to come down by at least 400 basis points over the course of 2024. And since that's about 30% of CPI, kind of there you go. So our CPI model suggests that we're only going to get 1 more month of a 3-handle CPI year over year, and that it's quite possible at this point that the headline CPI could be 2.4 in June. And if that's the case, I think the Fed cuts rates, because I heard Jay Powell, I think, say that, we can't wait until inflation's at 2, because he respects the momentum on the downside, because he learned a little bit of a lesson about the momentum on the upside.
He said, he said they're aware of the risks of waiting too long to cut rates. Jeffrey, he mentioned on numerous occasions today the possibility of cutting for the so-called right reasons. If the economy is just normalizing, you got from the outlook today, the so-called dot plot, 80 points of cuts next year. As I mentioned, how Leeman characterized this, the Fed moving closer to the market rather than the other way around. Would you agree with that? Do you see cuts, and several of them next year, for the right reasons?
I don't really see them for the so-called right reason. I think that's what's baked into the dot plot, and a little bit less so, but somewhat to the shape of the yield curve, that they're just going to cut by 0.75 of a percentage point or so, says the Fed. I mean, I think that's pretty unlikely. I think that if they cut rates that much, they'll have to cut them more than that. So I believe that we're going to see the yield curve de-inverting in the first part of next year. I think we're still going to have bonds rallying. We've broken down below the trend line on the 10-year Treasury yield that goes back a couple of years, and there's a lot of room below it. I would guess that we will see the 10-year Treasury yield in the low 3s sometime next year, and that would be consistent, in my view, only with the Fed cutting more like, I don't know, 200 basis points or even more next year. So I think we're looking for a recession next year. We've been talking about this. The market seems to be picking up on that. And we're starting to see the good part of the pivot from the Fed, which is relaxation of financial conditions. And that leads to, for the first moment, risk assets doing well. And of course, they've done very, very well since the last Fed meeting. And I suspect it's going to not be a trend change before year end. But I believe that I noticed the action of the stock market was interesting today because as the 10-year Treasury got all the way down to 4.0%, and it couldn't break through down to a 3 handle, I noticed that the stock market started to lose momentum. And then when it backed up on the 10-year to where it is now, just a few basis points. But there's something about if you break below 4 on the 10-year that I think it almost sounds like a fire alarm going off relative to the economy. And I think we might start to see the correlation of strong bonds and strong equities start to break down. When it comes to fixed income strategy, I outlined that I didn't like T-bill and chill. That's what we talked about the last meeting. I said there's nothing wrong with a 556-month bill except the fact that you only get it for 6 months. You wanted to be a little bit further out the curve, say 3 to 5 years in credit, and marry that with long-term treasuries. And all of that has worked. And I think that it's likely to continue to work in the new year, which is really interesting because I think that all this money that's in money market funds and that might be over-allocated to other assets than bonds and institutions, I think the logic that people have that money market bloat is going to go into the stock market is wrong. I think it's unlikely for investors to go from risk-free 6-month T-bills to the Magnificent Seven at massive PEs and all-time highs on the Dow Jones Industrials. I think they're much more likely to go from their mountain of cash in T-bills into bonds. And so I think that the strategies that I've outlined in the past couple of times we met, which have been this mix of credit in the middle of the capital structure and long-term treasuries, I think you stay with it for now. I've been thinking about that movie Braveheart, where they're about to attack, and the Mel Gibson character is saying, hold, 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 hold. You know, they want to fire or do whatever their assault is, but they have to wait for the right moment. I think you have to wait for the right moment to alter this bond strategy. And that right moment will be when the recession comes.
I mean, maybe some of the money in money markets is split. Maybe some goes into bonds for the very reasons you suggest. Maybe some goes into stocks because they see the possibility of a powerful new bull market developing. I'm going to go to, hang on just for a second, Jeffrey. Steve Leisman's just stepped out of the room, and I do want to go to him because, Steve, this was extraordinary on a number of levels, I think. Number one, the Fed chair in his news conference did nothing to walk anything back from the statement. He did nothing to hawk it up, so to speak. And I know he sounded like it would be premature, and he said as much, premature to declare victory. There was no jumpsuit, there was no aircraft carrier, but he doesn't seem like he's that far away either from doing just that.
Yeah, I think this was a pretty big day, Scott. I think that the Fed pivoted today. I think it went from having this bias to hike to being in neutral with a forecast to cut rates. And I think that's a pretty big deal. And he acknowledged in response to my question that, yeah, they sat around the table today and yesterday, and they talked about rate cuts. Here's a quote from the press conference.
The other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world and also a discussion for us at our meeting today.
Scott, I thought the chair might have tried to hold back the water on the dam one more meeting. I guess the data yesterday and today, especially the PPI and what it says, he mentioned this specifically. We talked about it on your show at noon today. What the data today says what's going to happen to the PCE numbers next week made it kind of untenable for him to hold back and to maintain a position that was too hawkish. And just real quick, we have been talking about this number that Jeff was talking about, this CPI ex shelter, which has been below 2% for several months now. There's that number right there, and you can see it. It's down below 2. And then, okay, so it's not fair to take shelter out. The reason you take shelter out is because the shelter component they use there is lagged about 3/4, Scott, from some of the other market-based indicators that are out there. And if you fold those in, you really don't have a problem. It may be that the Fed is already there. And the concern was that the Fed would keep rates high and depress the economy for too long based on bad data.
Steve, I appreciate it. Quite a day that I know we're going to be talking about many more times in the days ahead. That's our senior economics reporter, Steve Leeman, just out of the news conference with the chair. Back to Jeffrey Gundlach, who's with us exclusively, of course, from DoubleLine. So, Jeffrey, how come you're not willing to go as far as to say, you know what, I no longer think that we're going to have a recession? I'm wrong at this point. The economy is better than I ever thought it would be at this point. Inflation's come down much quicker than I ever thought it would be at this point. And you know what? Maybe the Fed's going to pull this off after all.
Well, I don't think inflation's come down faster than I expected to. It's really followed the trajectory pretty closely, and it's going to continue to fall further. I just think that a lot of the way the market works through cycles, I thought is so often the case. Brian Kelly, I think his name is on that segment before the announcement is read.
I know you're talking about David Kelly, and he was talking
David
about
Kelly,
a pivot that he saw that this was a pivot today.
Yeah, not just that, though. He points out that when you first start raising rates from low levels, it doesn't have real market damage. But then, similarly, when you start cutting rates from high levels, you start to affect the economy in a negative way, somewhat counterintuitively, because people might wait for lower interest rates if they think they're coming to do things, and it can accelerate the deterioration of the economy. And also, the Fed themselves is projecting a 4.1 unemployment rate, which would be up about 70 basis points from the low. And whenever historically the unemployment rate has gone up by over 50 basis points, it tends to accelerate from there to a higher level. It goes into another gear. And it's very consistent historically. I think there's a contradiction between the dot plot of the unemployment rate going to 4.1 and history. So I think that the Fed's going to be wrong on the low end for the unemployment rate for 2024. And I think that once you get the market de-inverting the yield curve and you start to really get the bond rally cemented into the DNA of investor psychology, I think that's usually the peak in risk assets. That's why I say it's okay now for the Braveheart idea of hold, 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 but you're going to have to pivot. And I think you have to pivot in a very intense way in both stocks and bonds when we get into the next recession. Maybe I'm wrong and it doesn't happen next year, but I think the odds have gone up, not down. We saw GDP now was about 5% or so in the third quarter, and it's now running, substantially less than that, and we're talking about maybe 1% next year. And I just don't think that's the way the economy works. Just like inflation overshoots on the upside, it overshoots on the downside. I think that the economy is going to undershoot on the downside, and the unemployment rate's going to go up, and that is going to create a totally different response. We're going to have to have a lot of money printing, I think, to battle the coming recession, and that's why you might have to pivot across the board, because the inflationary consequences of that could be very substantial. So this is a long view type of thing. But for now, I think the Fed's pivot needs to be digested by the markets. And obviously, a lot of that digestion happened today. And we'll see how the rest of the week plays out, because that pretty much takes us till the end of the year.
I want to sort of get your overall assessment of this Fed, because I remember so many of the conversations that we've had through this calendar year. Ones where you've suggested that, Powell was Mr. Magoo, going to drive into a wall. Other times suggesting he was up on this ladder and it's time to paint or get off the ladder.
Yeah, that was at the beginning. Yeah.
And here he is with this. What I felt today was a bit of a confident air about him in the way that he described this battle that they've waged over the last 12 months, and feels like they're in a pretty good space. How would you assess that?
Well, I think he does feel that way. And it may be transitory. He might just be in that Goldilocks sweet spot of that. But the Mr. Magoo thing was about how the Fed historically just keeps raising and raising until something falls apart. And he hasn't done that. As I said at the open, we've had 4 pauses in the last 5 meetings rather. That's a lot different than Mr. Magooing it and just bumping into dumpsters and stuff. He seems to have gotten in sync with the leads and lags a little bit better. I think he's learned something over the past 3 years, thankfully. And so we're at that point where he has repeated, as Steve Leeman said, he realizes that not all the tightening has gone through the system. So that's anything but hawking it up. I mean, that's him saying, some of the tightening is still yet to be felt. And that's going to be the case as long as we're higher for longer. As long as the Fed funds rate stays where it is, you're having problems in the system. You have a lot of loans. You've got banks that have investment portfolios yielding 3%, and the Fed funds rate's at 5 3/8. So they're losing money on that. You've got small companies that are having elevated borrowing costs, and every single day it becomes more painful. And every month they have debt at lower interest rates that is rolling off. The fixed rate debt that was maybe issued a few years ago at 1%, that's rolling off, and that's higher. And so this is working its way through the system. He understands that. And so I compliment him on that. He's learned. And I think the only thing I can fault the Fed for in the past 5 meetings is that they shouldn't have hiked at all. They should have stayed on pause the whole time. But that's pretty close. And one more thing I want to say about economic indicators is the commodity price trend, which has been straight down in a nonstop way on a moving average basis for the better part of 2 years. And the Bloomberg Commodity Index just can't get above its 200-day moving average and stay there. In fact, the gap is getting wider. And so it's interesting that gold's up today, not surprisingly, with interest rates down, but commodities broadly on the BCOM are unchanged. So the stubborn weakness in the Bloomberg Commodity Index is further suggested to me that inflation is going to be lower than people think. And I'm wondering if we won't have a 0 year-over-year inflation at some point in 2024.
I understand why you make the bullish case you do for bonds, which have, as you said, had a historic rally. November was the best month for Treasury since the 80s. For obvious reasons, we've dropped near 100 basis points on the 10-year, for example. But why shouldn't people buy stocks today? Why shouldn't they say?
If you want to buy, because they're up massively since the last Fed meeting, and they're in pretty rarefied territory, and the economy is going to be slowing, and earnings are going to be less robust than people think. But if you want to own stocks, and of course everybody owns some, I think that one trend that has been very clear throughout 2023, for good reasons, is that equal-weighted stocks like lower interest rates, and they don't like higher interest rates. The Magnificent Seven don't care, really. They're in a world of their own. But we've had a lot of talk about equal-weighted versus market cap-weighted, and we've seen equal-weighted do quite well since the last Fed meeting, and there's a reason for that. The Fed hikes hurt the equal-weighted more than the market cap-weighted because it's the smaller companies that get taken out by higher interest rates. And so I think you want equal-weighted rather than market cap-weighted at this juncture. And so I don't think there's a terrible valuation in the equal-weighted market, but the market cap-weighted market
it's maybe 15 times in the equal weight, but it almost sounds like
it's a little too high.
Someone could take what you're saying, though, but someone could take what you're saying, Jeffrey, as making the case for an everything rally, that the equal weight part of the market, the S&P 473, for lack of or 493 for lack of a better description, obviously, is going to get a boost now if the Fed truly is done hiking and the next moves, multiple of which are cuts. The economy's still hanging in there. Why not?
Well, I just think that the everything rally concept is a realization of what's happened in the past 6 weeks. And we kind of expected that because we now have the full Fed pivot. It sounded pivot-ish, but it was more balanced back in November 1st. But now we have a full Fed pivot with the word any showing up and Powell talking about lags and all that stuff. So I just think that we're getting late in the cycle. And you can hang on there with risk assets. And I'm not exactly advocating against it, particularly in the higher credit sectors, but not investment grade, but maybe double B sectors of parts of the bond market. But even there, I think you will have a reversal come the middle of the year. So we can hang in there for now, but I think stocks are pretty overvalued versus where they were, say, I don't know, 6 weeks ago, or certainly back in March.
It is a stunner, lastly, before I let you go, that, you know, as far as yields have come down, you mentioned, you know, you'll have low threes by the end of next year sometime. We could have high threes by the time I say goodbye to you here today, which is remarkable considering we were at 5% not that long ago.
Yeah, October 23rd. In fact, the New York Times had a business section article that I saved because it said rates are not going to come down anytime soon. As the cover of the business section, I said they're ringing the bell. But there's an old I'll leave you with an old saying that old timers like me used to cut our teeth on, and that is stocks need bonds, but bonds don't need stocks. And right now, stocks are needing bonds and they're getting it. But we'll get into that phase, I think, in the second quarter or so of next year, where bonds don't need stocks, but stocks won't be participating the way bonds will. So that's how I think about the pivot. But I also think it's going to be a year of great volatility in 2024.
Well, we'll look forward to spending it with you. I can say one of the true highlights of this year, Jeffrey, was spending every Fed day with you exclusively here on Closing Bell. I look forward to doing the very same thing next year. You have a good one. Stay healthy. Happy New Year, and we'll see you.
Yeah, good luck, everybody, and good luck in the new year.
All right. That's Jeffrey Gundlach, once again exclusively from DoubleLine with us right here on Closing Bell.